mic, bring the facts. Erin in the ring, no turning back. Coby got the numbers clean and clear. Experts in the mortgage space right here. Housing issues, yeah, we dig deep. Every word weigh when the stakes don't sleep. Credit war, you can feel that charge. Every point hit hard, every stance large. Capital hill, that pressure stay high. Consolidation makes the small ones fight. Servicing trails, every detail counts. Say it plain, then we write it out. No surrender.
Hey. Whoa, who's that?
I was told
that's amazing.
To be on
That's unbelievable. Brendan McKay is here. What are you doing here? This is the guy that runs the BAC, the Broker Action Coalition, one of the greatest lobbying arms of our mortgage industry. What's happening, brother? Good to see you.
All sorts of good stuff. Thanks for having me on.
Yeah, well, you're on about a minute before I thought you'd be on, so I'm having to shuffle the deck here. Erin, what's up? Good to see you.
What's going on?
Good to see you with makeup on.
Yeah.
I can appreciate that very much. Although yeah. I will say this is your post, so I'm not making fun of you. This was a post you had yesterday. You had no makeup on, but you look beautiful.
Natural beauty.
Yeah, I'm telling you right now. I mean, this is quite a splendid picture of you. You just returned from the Ohio Mortgage Bankers Association.
Yes.
Where you and our the friend of the show, 𝐒𝐮𝐫𝐫𝐞𝐳𝐝, spent some time together. This is pretty good. This is the four of us. We're all moving in together. We're just a happy family now. Me, Coby, Rich, and of course you. We all know who wears the pants in this family. They're on the far left, and we're all wearing the trademark 𝐒𝐮𝐫𝐶𝐽 vest.
Yes.
Yeah. I'm not sure anybody's wearing pants in that picture.
I can see why you wanted me off camera for this section of the show. This is wonderful.
Give us a quick lowdown. I know that Rich was just blown away by the amount of people that came and the impact that was seen and felt.
It was absolutely tremendous. You know, so the first thing you have to love about 𝐒𝐮𝐫𝐶𝐽 is the man never changes who he is. He rocked a Viore vest every single day, interviewed Bill Cosgrove on stage with that same Viore vest. He put together an amazing lineup. I mean, he had really good keynote speakers, had Jody Hall, Melanie Colton, a bunch of others. Maurice Claret was there, and then really good, meaningful breakouts with speakers from all around the country. I got to meet a ton of cool new people. Columbus was beautiful. The weather was amazing. I had an absolute blast. So well done, Rich, and the rest of the Ohio MBA. Adam Rose, the outgoing president, did a great job last year. So it was wonderful. I'll be back.
Bill Cosgrove from Union, did he show up?
He did a keynote on Sunday. I missed it. I was en route, but he was there.
Yeah, we'll have to. You were en route or en route?
I don't know. Whatever you're supposed to say. I'm dumb.
No, yeah. Okay. Sure. Yeah. Far from it. Coby's here today. We've got some things that have changed in the background. Coby again. Now you've got a Knicks jersey hanging. I don't know what's going on there. Maybe I do know what's going on there. I'm surprised you're not in New York for the rally today.
I thought about it. I was did a tour of California earlier this week, and now I'm back home, but I was running around the state. Believe me, I wanted to get to New York for the parade, and my brother's there, actually. He's been sending me pictures and videos all morning long, and he left his house at 4 this morning to go do that. The FOMO is real.
Yeah, I bet.
And it's been a great week connecting with everybody on LinkedIn that knows that I'm a Knicks fan, and everybody, my friends back home who, are celebrating this. Just a fun thing for New York. We've waited so long for it, and some really good news to revel in for the summer.
Yeah, hopefully they'll rub off on the pathetic Jets. The NFL season is coming around, so who knows?
Yeah,
we have a lot to cover today. We're going to talk to Brendan about a pretty thought-provoking post he had around credit in the bureaus. FOMC first meeting, Kevin Warsh. What do we think? Veteran United's survey they did, which I think is a little bit counterfeit. We'll talk a little bit about that. Figures deal. The PLS market continues to gain amazing steam. The FHA fund, MISMO frame. And then we'll also talk about the housing bill, which we think is going to pass here in pretty short order and what's inside of it. But before we get to any of that, we've got Brendan on, who earlier this week, or last week rather, had a pretty straightforward post about the three credit bureaus and how they continue to raise prices while offshoring much of their workforce. Brendan, great to have you here. Tell us about why you made this post and what is the point you want to drive home.
Yeah, absolutely. Thanks for having me. I mean, I knew it would be new information to people, not exactly shocking that, you know, the credit bureaus are interested in their bottom line and no one else's. They have no interest in, you know, coexisting in the ecosystem within the mortgage industry at large. And as such, don't have a huge amount of interest in existing in the American economy at large. I thought the numbers were absolutely shocking. I think attention should be drawn to it. And I knew it would get a lot of attention. When I realized this was the case a couple months ago and we started working on it and putting all the numbers together, which frankly, we were incredibly favorable with. I think the real numbers are actually worse than this. They're 2 years old. And whenever there was like a number like 5,000 plus, we gave them credit for 5,999 and things like that. But they're turds. The credit bureaus have consistently taken complete advantage of a privileged position that they have. They're an underregulated, government-mandated monopoly, and they act like they're in a free market. And I'm going to continue drawing attention to their awful abuse of this privilege until something's done about it, which is hopefully sooner than later.
So what made you tackle this? You just wait. Why was this in your crawl? Was there any one particular thing that happened that made you shed light on this?
No, I mean, well, coming to the realization that this was the case, but no.
His Wi-Fi is incredible.
I've had a couple years of treating the credit bureaus like a pinata that I feel like they should. Trigger leads was what started, you know, their behavior that pissed me off in the first place, and I thought was completely unreasonable. And we've addressed that problem. But every time we dig into something that they're doing, the worse and worse that it is. And I think, like any bad behavior to this level, should be highlighted.
All right. So your beef here is that Experian has 73% of their workforce overseas, Equifax 62, and TransUnion 42. You think that this says something about their commitment to America?
Sure. Yeah, absolutely. And I recognize they're not alone in moving employees off seas, but I think when you look at it in the through the lens of the fact that the United States government has essentially mandated that they're a monopoly or oligopoly, yeah, like the United States government sure as hell is treating them real good and creating a business environment that everyone would kill to have. And what do they do in return? They move all their workforce overseas. I'm not a big fan of corporations moving their workforce overseas in the first place, but I think that if they're going to get their back scratched to the degree that they have by regulators, it's the least that they could do to create some American jobs. Absolutely.
Coby, what are your thoughts on this? Is this something that we should be upset about?
Yeah, something definitely to be upset about. I mean, you know, look, trigger leads to me, and I'll push back a little bit on you, Brendan, just in terms of where to spend political capital. Trigger leads was a huge thing, right? It was a huge nuisance to borrowers. It eroded the trust of the industry. It created major headaches for lenders when they started pulling credit and customers are getting bombarded. I know that there's talk about the $540 cost from the CHLA. I know that you spent, based on the article that I read, $5,000 in 1 month on credit reports. But is this where we want to spend political capital, or are there bigger issues that the BAC should be tackling?
There are bigger issues, and we are tackling them. Whether we're making as much public noise about those issues or not, it can be two different things, because we're fighting multiple battles at the same time. Like, we are fighting a bunch of battles on a lot of different issues on Capitol Hill. We're also fighting a battle for attention within our industry, largely online. And we think about what we're going to make the most noise about, not just about what the most important issue, but what is an issue that is also something that we think we can make movement on, right? Like, there are a lot of issues that we are focused on or paying attention to that we think are losing battles at the moment, or that we don't think is going to get a ton of attention online, right? So we're considering all these things at the same time. And so to your point, I was having a conversation with a colleague about how out of control the cost of title insurance has gotten and how much worse that is than the cost of credit. And I'm like, you're absolutely right. We have made noise about this in the past, and we could be sitting over here in a lone voice off in the corner spouting off about something no one else is paying attention to, or we can ride a wave of the fact that the credit bureaus have been getting the crap kicked out of them by the rest of the industry for the entire time, and join a conversation that's already happening and bring new information or a unique perspective to it. And there is a strategy approach to that, undoubtedly. But no, is getting credit report costs down going to fix the housing affordability crisis overnight? No, and no one thing is, but I agree it's not the most important thing in it, but it's a problem that needs to be solved, no doubt.
Erin?
I'm so glad that you brought all of this up, because I know that sometimes, in DC, there can be a difference between brokers and bankers, and we can be at odds. But I think this is something that we all agree on, and that we can all fight for, because at the end of the day, FICO's increased prices and the CRAs have increased prices. They've all achieved higher revenues. And the only person who is losing in this is the consumer, the American homeowner, who is now paying however many times or percentage higher, whatever number you can pick. Is it 500%? Is it 15%, 1,500%? They're paying more, and they're getting absolutely nothing in return for those higher costs. And so one of the things that interests me about what you put out is getting Congress to act, right? And so what are your thoughts on trying to get Congress to treat the CRAs more as utilities, who would have a mandated cap on what their ROE could be, because they are mandated. We do have to use them. We have to use all three, because the data all three have individually is such garbage. We have to use all three together. What are your thoughts on something like that?
So I think there's two ways that you can go about it. And we always want to present both options because, we want to be careful about throwing around regulation. It's a big, scary word in our industry, as well as with one of the political parties in DC. And the two options being either open up the market and allow other data aggregators to become credit bureaus, set the bar very, very high. But that is possible, or keep it closed and regulate it, to your point, just like the energy providers. And Senator Josh Hawley is going down the antitrust path with FICO, and we have had conversations with their office about yes, here's the problem with FICO. By the way, they're probably the second biggest asshole in the room when it comes to this kind of stuff, and the credit bureaus might be worth looking into as well. So that is if you're talking about actually solving the problem, that is.
Well, who is the first asshole in the room? Is that the bureaus?
The three-headed monster of the credit bureaus.
Interesting. I find it interesting that you have it in that order. I have it in the opposite order.
I mean,
the price increases start with FICO, and it starts to roll downhill from there. Maybe I'm missing something.
You sound like you're reading right from like one of the credit bureaus' press releases when they're increasing costs. I mean,
I'm just talking facts. Where does it start? It starts with FICO, doesn't it?
You could say it starts with FICO. You could also say the credit bureaus have been using FICO as cover, and completely throwing them under the bus and beating the shit out of them in a PR battle over the last couple of years, which I think has happened. Has FICO been increasing their costs more than I think is reasonable? And are they also in a privileged position as a monopoly? Yes, absolutely. And as a percentage increase massive? Yes, absolutely. When you're looking at raw dollar amounts, the majority of the bloat, at least according to CHLA's white paper from a couple of years ago, does sit with the credit bureaus. So that is the reason. If we're talking about actual dollars coming out of my bank account or the American consumers, I think the credit bureaus are the larger problem than FICO. But if you're right, Greg, as soon as Vantage is fully implemented in the market, like we're going to see $60 credit reports if that's the case, right? Like the credit bureaus are the ones that own Vantage, so they should. And if FICO is the problem, we're going to find out really quick what the actual truth is.
Brendan, where does what's the path to the fix? Because you mentioned Josh Hawley and an antitrust suit potentially, but isn't this something that soon-to-be former acting DNI Bill Pulte could remedy if he wanted to from a policy standpoint?
Yes, absolutely.
So why do we need to go to Congress? Is it just the political pressure that Congress can deliver? But do we need that?
No, you don't need it necessarily. But do I approach this, and I'm incredibly proud of the work that the BAC has done in a short period of time, but I also recognize that we're not the Mortgage Bankers Association. And are they going to do things simply because we ask? No, maybe. But like, I would rather put as much pressure from as many different angles as humanly possible to solve a problem that large. I mean, what you're talking about, for example, FHFA saying, okay, credit bureaus, we need to rework this system or else we're going to open it up and put some contracts in place and this and that. They're not, and I don't know that it would necessarily be reasonable for them to do that on, I don't want to say a whim. That's way too, casual, but to do it without serious thought or consideration or Congress pushing them in that direction. I think there would be some appropriateness to it, even if it was in the form of them sending formal letters rather than actual legislation and things like that. But it's more of just a strategy of getting as much pressure as possible.
Do you feel like you're aligned with the MBA in this?
Yes. Well, I don't want to speak for them. And I almost wanted to, when Erin mentioned brokers and bankers not always being aligned in DC, I would actually push back on that. I had drinks with Bill Kilmer on Monday, in fact, and I am in regular communication with the MBA, and we're on the same page the overwhelming majority of the time. I think the division between bankers and brokers is largely something that what was real a couple of years ago, 5-6 years ago, and now is just perception hasn't caught up with reality, at least in Washington, D.C. And my message to brokers all the time is like, we need to be aligned here. We should be aligned everywhere. I would love everyone to knock it off on social media, but when you're in Capitol Hill, you've got to be on the same page, and we don't throw anyone under the bus. But on exactly what the path forward is, I think that we would have some different, different exact ways of going about it, but we all agree that this is the root problem. I mean, Bob is throwing around terms like oligopoly and things like that too. So I think when it comes to the big picture stuff, yes. Are they out there saying either open it up or regulate it like I am? I'm honestly not sure, but I don't think they'd be like, that's a crazy idea either.
Erin, you want to jump in here?
Yeah, I mean, I'm actually really glad to hear you say that, because I agree. And I think especially from a legislative and DC perspective, different business models, so we still have the same issues that we need to address. And so I love that. That's fantastic. So we talked about regulation, right? And I agree. I'm not a fan of regulation. But if we're going to be forced to use them, I think that's an option we have. What are your thoughts on some of the other non-regulatory ideas that have been thrown out there to address the problem?
Sure. So I think if you're talking about whether it's single bureau pulls or the back is pushing making credit reports portable, just like appraisals, I think they are more than a Band-Aid solution, but they're not a total solution to the problem either. I think they improve things and start moving the conversation in real ways towards the actual solution, but they're not going to solve it in and of itself. We are supportive of single bureau. I recognize that there's valid criticism of it, but we do think the back thinks it's a net positive. Our energy is focused on, when it comes to more medium-term improvements, making credit reports portable rather than driving the actual cost of reports down. Just reducing the number of wasted pulls that are happening so that the cost goes down in the aggregate is something that we're pushing very much. And working on talking to FHFA about.
What is the reason why? Go ahead, Erin.
So I think you're right. I mean, some of the ideas that single poll, again, it's got its critics, it's got its proponents, but I think what is happening is the conversation is being pushed forward. We're now talking, can we leverage Fannie and Freddie don't even use the score. It's just used for pricing. Is there a way that we can leverage the internal analysis by DULP, or can we look at cash flow underwrite, that kind of thing? And so I do agree with you there. We're getting some interesting ideas thrown out there. Some are better than others, but it's the conversation is that we weren't having 2 years ago.
100%. I think obviously DU and LP have some sort of behind the scenes, risk. Like there's shades of gray that are happening back there. And I think
how many? Are there 50 of them? Are there at least 50 shades of those of gray?
I expect that from Greg, not from you.
You don't know Aaron D.
And
Buckle up, buddy. Buckle up.
I think it would be a good thing, and it essentially eliminates FICO or Vantage from the equation. But as you know, all of these things would move the needle in the right direction. But would it really solve the root problem that we're talking about here? That we have an underregulated oligopoly happening, government mandated? No. And there's counter arguments to all of this. It's like, well, if you're going to reduce the revenue that bureaus are getting, they're just going to raise the costs in response. And my response to that is twofold. One, I reject it on the premise, because you're taking a free market argument and applying it to a situation that's not, right? So, but secondly, I'm like, okay, I don't want to say good, but kind of good, because the more they raise these costs out of control, the more pressure that gets put on, both socially and politically, towards what we all seem to agree is the actual solution to the problem. And that's where we want to get.
Well, I'll tell you what, Brendan, the portable credit report idea is a great idea. There is no reason, of all the ideas that have been kicked around, there's only one reason actually that I can think of why this wouldn't happen. It's all the money that's flowing in every direction. Why should a consumer have their credit owned by another entity and have it, be charged every time they want to ring that bell? I mean, if anything, it pushes them against competition, right? Because how many times do they want to get dinged every time it happens? Someone's paying a price in some way. But aside from that, there is progress being made. I mean,
Absolutely.
the Vantage score is out here now. It's too early to tell the impact that it's going to make, but there has been progress, and I think it's a wait and see game now to see how it gets adopted. And as far as Pulte's concerned, when he came out, and maybe all of this is for naught anyway. Maybe we're just wasting a lot of time, because when he came out and announced that Vantage Score was live, him and Secretary Turner at Fannie Mae headquarters, I don't know, it was probably 2.5 months ago or so, he did throw in a comment there that with AI making the strides that it is, that there should be another better way. And so you would have to think that we're going to reach a time where this isn't as costly, and there are easier ways, and maybe it's not under the control of these companies anymore. It should be really, really interesting as this develops. Any parting thoughts from you, Brendan?
Yeah, on Vantage quickly. While I don't think it's going to bring the cost of credit down, I think, or credit reports down, I think Vantage entering the market is an overwhelmingly positive for much bigger reasons than credit report costs. So I'm of the opinion that especially when FHA has Vantage, it will turn some people who could not get qualified for mortgages into homeowners. It will turn some FHA borrowers into conventional borrowers, and it will give some conventional borrowers even better terms than they had previously, right? I'm not saying Vantage is better than FICO, but it is better for some consumers, right? And if I'm right about that, I think we're going to see a big opportunity for refinances. Once Vantage is live, anyone that does any relevant amount of FHA business should be sending out an email to their entire past FHA database and saying, hey, there's a new scoring model out that may be more favorable for you than FICO was. Why don't we take a look, do a soft pull, see if it's helpful for you? And I think there's going to be a massive amount of opportunity for refinancing those eligible borrowers from FHA loans into conventional ones. So I think bringing down the cost of homeownership and making people homeowners that wouldn't be otherwise is a much bigger deal than bringing down the cost of credit reports, something that I'm also incredibly passionate about.
Amen. And later in the program, we're going to tackle FHA delinquencies and a rising number Coby says is conflated, and he will bloviate. Brendan, thank you, my man. Great seeing you.
Appreciate you guys. Thanks for having me on.
Yeah,
so
keep
much.
advocating for the industry,
travels.
man. You do incredible work. Thank you very much for all you do for all of us.
Appreciate y'all.
All right, brother. See you later. All right, let's jump into the FOMC meeting. The first one, Kevin Warsh ran. It was a lot different than the ones that we're accustomed to. Here's just a little blurb from yesterday's meeting.
I heard was the kind of humility that I think we should have. I did not submit a dot. For me, it's not helpful in the conduct of policy. I suspect by year end, as I mentioned in my opening statements, there'll be a review about communications broadly, press conferences, dots, meetings and the like, transcripts, minutes. This will be part of that.
Loved it. Loved everything about yesterday's presentation. It was short. It was sweet. It wasn't forward looking. Let's be honest, every time we see a dot plot, every time there is forward-looking whatever, it always gets adjusted anyway. It's like a weatherman trying to see if it's going to rain in 6 weeks. It's just impossible, right? So I liked what he did. He's got a task force, which I know you're going to focus on here, Erin. Is there anything that you didn't like about how he presented himself yesterday? And then we should get into contextually how that compares to what Chairman Powell did over many, many years. Erin, you get first at bat here.
I generally really liked what he said. I thought, he came out with like you said, he was short, he was concise, he wasn't overly combative at the presser. I thought he answered questions reasonably. I thought he was fairly open in answering questions. I mean, honestly, the only thing that I didn't like about it is he's changed the flag configuration behind him from how Jay Powell was. Jay Powell had the US flag, the Fed flag, the US flag, the Fed flag. This time it was like each on separate, him in the middle. So, that was another big contrast that I saw. But generally speaking, I liked it because it shows that he's being thoughtful. He's not just trying to do things the way they've always done it. Obviously, the devil's going to be in the details, but I like that he's looking at how the Fed operates.
Yeah, I don't trust this guy. I don't trust this guy. I mean, we know who appointed him. We know he's like Estee Lauder's grandson-in-law. So this is like a Trump family pick from day one. He had no choice but to say what he did yesterday. And I think the fact that he's going to put out less forward-looking views, of course, things change, but you've got to put some signal into the marketplace so that the market can have a reaction, so that we can, kind of digest that information and then
a
change
reaction or an overreaction, because that's always what we get.
Well, we don't always get an overreaction. We've gotten some overreaction from Powell, but we had one of the strangest markets anybody's ever had in the history of markets with the pandemic and then the post-pandemic surge.
If you go back through the notes, there have been instances where Powell moved the market. Okay, when everybody was saying rate cuts were coming, and Trump was even saying it, he went to great lengths on that same stage to say, not so fast. Literally said, I wouldn't count on that. Like he's not supposed to be interjecting those. And that moved the market, by the way. The market went down considerably on the back of those words. I don't suspect that Warsh is going to do that kind of thing, Coby. And I know I cut you off, but let me continue. Let me, don't be mad at me. Are you mad at me?
I'm not mad.
You're not mad?
I'm not mad.
Erin, are his feelings hurt?
Should I be mad?
Well, I mean, your first comment really takes me aback a little bit, that we know who appointed this guy. I don't trust this guy. He's Estee Lauder, this or that. I mean,
we also know his past. We know his past.
Yeah, well, his past is extremely hawkish. So yesterday he seemed to be himself. Why would he come out knowing how the midterms are coming up, knowing the direction things are heading in? It's not a good one for Republicans. Why would he waste any time? Why did he have to say what you said? You said he had to do this yesterday. He didn't have to do shit. He could have come right out and said the things that you obviously think he's eventually going to say.
Yeah, I think he will. And what worries me most about this pick is not what he's going to do under the Trump regime. He'll do under the Trump regime whatever he can to implement the policies that he was expected to when they brought him on the job. The two questions I have are, what kind of consensus can he build with the board? Number one. And number two, what happens in a year and a half when the Trump presidency is over and he's still the Fed chair, but now he can go back to the way that he used to run things back in 2011, or the way they used to act in 2011, 2012, 2013. So what kind of Warsh are we going to get when this current presidency is over? And what kind of consensus can he build, especially with a board that still has Powell on it?
But wasn't it 12-0? Like, wasn't the vote 12-0 unanimous?
This is yesterday. What I'm talking about is what's going to happen going forward.
Looking statements.
No, yesterday was very divided. I don't have the exact stats with me, but there was nothing.
Oh, I don't know that. I'm wrong on that. I thought I saw.
Yeah, Erin, pull it up while we're talking, if you would.
Yeah.
But Coby, Brian,
the vote was unanimous. The vote was unanimous.
Okay,
no, there was unanimous what? That there would be no
Coby's right,
cut.
100%. They all voted for. All voted to stay.
No, I understand that, but there were positions in terms of who thinks dot plots and projections, and people who thought there would be two cuts, at this period of time this year, and some thought no cuts, some wanted cuts. That's what I'm referring to. So unanimous that there wasn't a cut yesterday. Yeah, but I mean, but it's inside that room. Based on that, the numbers I just talked about, which aren't precise, but I think you want a divided room. You want conversation. You want a good, strong dialogue. We are definitely at an inflection point, but I just find it so interesting, Coby, that you are worrying about what's going to happen when Trump's regime is over, when we have a lot hanging in the balance today. I'm also surprised, I feel like this is just a red-blue thing with you. Like I'm surprised that you don't like you're a very orderly guy. You like things very, in their place. And for him to come on like that and not bloviate, we know who the number one bloviator is in the history of bloviation, by the way. That's Donald Trump. You shared that with us last week. But in all seriousness, I mean, he came out very in control. Right? He could have sent the market spinning in one or the other direction yesterday. If anything, the market tightened a little bit. We lost considerable ground, I believe, in the bond market yesterday because of that. That's not Trump-ish. That's not good for Trump. So I'm really surprised. Maybe talk to your therapist about whether you're just sticking to the red lines there. I don't know.
Well,
Yeah,
he said
something
that
something to
was
pencil
incredibly
in.
nuanced.
What,
When
Erin?
someone asked him if they thought current policy was restrictive, he got nuanced. He said, in housing, I think it is overly restrictive, and in other areas, probably not. Right, which I thought that was a very interesting way to delineate. And I think when we get these task forces, like, I'm a super nerd, and like when he mentions that they're going to look at the data because the data that they see is an echo of the past, he's acknowledging that the Fed is acting and making decisions on data that is not timely, not relevant anymore. And I immediately, when I heard that, texted Danielle DiMartino Booth, and she's pumped about that too, because we've got to be using alternative data sources that are far more timely. And so if one of the outcomes of Warsh is going to be that the Fed starts to look at better data, that's a win right there.
Yeah. Coby, did Powell do a good job?
No. Why
Powell,
not? Powell, well, for some of the reasons you delineated, he was overly reactive. He made it personal at times. He thought he was bigger than the job itself at other times. Towards the end, it was a complete disaster where he just decided to go to war with the administration because Trump was picking on him, even though he was a Trump pick. He didn't do a good job. My worry about Warsh is, he's saying the right things now. He said repeatedly in that press conference, he used the term strictly independent as far as the Fed goes. So if you look at what his words were yesterday and the things that he signaled, was that something that I could say, okay, I can accept that? Yes. And my point wasn't to tear him down for what he said yesterday. It's more, I still don't trust the guy. I don't trust the pick.
You don't trust his boss. You don't trust his boss.
And I don't trust his boss. Correct.
Yeah, that's really what it is, right?
That's part of it. That's part of it. And I think anybody that was going to supplant Powell was going to be the pick of his boss and would have elicited probably the same reaction from me.
Yeah, and so Trump, we're not focusing on his words at all, but maybe we should be, because yesterday what he said was basically whatever, right? So, how long until he starts like slamming this guy? And that, I think that there should be some kind of a bet in Vegas on it. I think as the midterms approach and the pressure ratchets up, like there's got to be like the predictions market's got to be saying, when is the first time Trump is going to rail on his handpicked choice? Because Powell was his choice too. Let's not forget that. So to your point, Coby, but I think it starts up there. I don't think it starts. I think for all that he's accomplished and how hawkish he's been, and look, he didn't like Warsh didn't like QE. He didn't like that last tranche, which basically, locked up. It was very bad in hindsight. Now, granted, it was on the backs of a once in a lifetime pandemic. So Powell was just doing what he thought was right, not taking anything away from him. But at the time, he said it was unnecessary, that we didn't need to do that. So I really don't want to impugn the guy. I want to give him a shot. I'm not saying you do. By the way, before we move on to the next topic, Brian View, our good friend, wants to know if that's Spike Lee's jersey back there behind your shoulder. It looks like an extra small. Not sure what's going on there. Any feedback on that?
It's really just a perception thing. It's not a tiny jersey. It's just about 15 feet behind me. But that's Josh Hart's jersey, who is probably the heart and soul of the Knicks and one of my favorite players, and same number that John Starks wore back in the 90s. So it's a very special number for Knicks fans.
Oh, excellent. We're going to start to read some feedback here. Normally we don't do this that often during the show, but we'll take a couple of breaks here and there. Ira Selwyn, the market needs to hear what the Fed is thinking. We do need to hear forward thinking. Task forces are good. Yes, but more volatility will occur without the updates. Interesting, contrarian take to what I said. Coby, it seems like you might agree with that a little bit more than I do. Margaret, Smart guy?
Ira's guy.
Well, there you go. Margaret Templeton, there are no guarantees. Elections have consequences, or so I have witnessed. Sorry, I've been told. Okay. All right. Well, let's look at another thing we've been told. This is really controversial in my eyes. I can't wait.
One thing though,
Yeah,
I do want to
Yep.
give a shout out to Brian View. I know he watches us every week. He is a big fan of the show. And I even forgive him for actively rooting against the Spurs when we went out to watch the game together last week. So, what's that?
He actively rooted against the Knicks. Not the
He
Spurs.
did. Yeah. So I do forgive him for that. Still much love to BV.
Yep, he's one of the great guys in this business. We'll be talking about him in just a little bit as we talk about Frame, which is probably the most important white paper that we've seen in many, many years coming out of the NBA. But we need to talk about a lot of other things, and this thing really got to me this week. This is Veteran United survey. Okay. So Veteran United did a survey surveying 400 people, half of whom were veterans, asking, would this population of 400 people be comfortable with an end-to-end mortgage experience, no human involved? And basically, their findings were that 53% of the people that were surveyed said, yeah, that's what we'd want. We'd want an experience, and we'd be fine with an experience that did not involve a human. And definitely I took exception with this, because what happened then, ladies and gentlemen, is everything started to hit the headlines. This is just one little Google search. More than half of buyers comfortable with AI-driven home buying. More than half of buyers saying they'd purchase a home without human help. Home buyers now trust AI at every step of the biggest financial decision Veterans United survey finds. So, why does this bother me? Well, first of all, it's a very small population of people. It's 400. And so for this to be painted with such a broad brush, and I don't blame Veterans United for that aspect, right? The news feeds picked it up and they just run with it as well. But 200 of the people, 50% of those surveyed, are veterans. And it is a fact that veterans are much better with tech than civilians. It's just, they even mention it in their survey. So that's skewed right there. And then some other bits and pieces that I found fragmented that didn't really hit the mark. 36% surveyed were 18 to 34. So, I mean, my son is 16. If you asked him about this, he'd have no clue. 48%, 33 to 54. Okay, that seems like in the groove there. 16%, 55 and older. 68% were repeat buyers. Only 32% were first-time home buyers. Shouldn't we be talking to first-time home buyers? This is a very forward-looking thing. So I feel like it's not a real true indication. And it's not that I'm against it. I think we're going to reach a day when potentially the majority of consumers are going to want to do it this way, but it's not today. And so for the message that sends to LOs, the competitive advantage in a very sneaky way that it gives Veterans United perceptually, because they are heavily direct to consumer, I have problems littered all over this. Erin, enough of my rant.
Yeah, Coby and I had the opportunity to meet a very nice gentleman at Chairman's named Adam, I believe, from Veterans United. So I'm sure he'll have some feedback for us on this. But you're right, it's a limited study. And if you look at the Totality study that was released in April of this year, it shows very different numbers. It shows that 55% of home buyers prefer to work with a human. It said that 44% would pay extra to have that human in the loop. And it's showing declining numbers of people who have trust in AI throughout the home buying process. And there's lots of other stats I could rattle off. So if you want to get a true feel for where consumers are, the Totality study is a much more comprehensive, large scale. And I challenge people to look at that when looking at the veterans numbers.
So do you buy the survey, Erin? Yes or no? Or do you think the survey is indicative of what the market feels, or do you feel like it's misleading?
I think it's misleading if you're representing the market as a whole.
Okay, thank you. Coby?
Yeah, I mean, several problems here. And anyone who follows me on LinkedIn knows that I talk often about controlling the narrative and how we need to be the ones in this business telling the story, being honest about what the problems are, being honest about what the advantages of homeownership are, what the mortgage process looks like. I have to say I'm a little disappointed that a member of our community, a mortgage lender in our community, put out a survey with such a small sample size and that was actively trying to get this kind of news media and earned media attention. 400 respondents, some of them, of the respondents that you didn't notice or that you didn't note in your rant, said that they were at least almost 3 years from buying. So these were people that were not even in the market now and may not be for another few years. And if you're 3 years from buying, you might as well be 30 years from buying because it's just something that's in the future that you're not thinking about at this moment. The totality study, not only is that 55% number, but it was up from 46% a year earlier. So the trend is going towards people wanting a human in the loop and at least that human off-ramp. It also fell from 14 points from a year before. It fell to 16%. The number of people that would that trusted AI to find a home and the number of people that would pay extra to have a human in the loop actually went up as well. And that was a study that was across 4 different countries. So the sample size there was much bigger. It's in that study as well. Only, the 53% said they would feel comfortable. Only 25% said they would feel very comfortable. So what's the distinguish between comfortable and very comfortable? Very comfortable to me means I would actually action on it. Comfortable means like, I'd take a look at it. It's the fact that we're talking about it today and it got that much attention to me shows that, we've had a visceral reaction to it. I think the mortgage market has had a visceral reaction to it. I think everything's pointing to the data being, shaky at best. And I think we need to do a better job of being out there combating this sort of misinformation. So I do like Veterans United as an organization. I do like the gentleman that we met last week, but they're off the mark here.
Got it. Is it brilliant marketing though? The fact that we're talking about it and that it's and that they got what they got.
Yeah, great job.
Yeah, it got a share rant.
Yeah, it's misleading though. It's interesting. I mean, I love marketing. That is at the root of who I am. A marketer for sure. So, yeah. All right. Well, I think we've talked about this enough. I mean, I think it sends the wrong message. It's irresponsible, but I understand why they did it. I just think that anyone, if there's a takeaway here, it should be that when you see surveys, look into it, consider the source, look at the numbers, look who's paying for it. I mean, there's the United Wholesale Mortgage Survey that said that when dealing with a broker, you save, 10,000, whatever amount of money over the life of the loan. Turns out we know no one sticks with a loan for the life of their loan. It was literally pennies on the dollar, yet they threw out this huge number and tried to rally the broker community on it. And again, they paid for the survey. So just consider the source would be the big point. Tom Anderson says misleading, not surprised. Veterans United should be more concerned with their class action bait and switch lawsuit. I didn't want to bring that up. But yeah, I mean, they're in, they're in potentially hot water. The accusation there is that they have represented being part of the government and have duped people into getting some of their loans. All right, so let's pivot into Figure Technology Solutions, traded on the NASDAQ, acquiring 𝐒𝐫𝐫, an AI-powered lending platform for residential real estate investors in a $717 million deal. The deal adds roughly $7 billion in annual first lien volume and $100 million in monthly flow to Figure's blockchain-based, democratized, prime tokenized asset marketplace. Erin, I know you're all over this. Why does this deserve our attention in the mortgage business?
Well, first of all, I'm a fan of what Figure's done, right? In the second lien, the HELOC space, they're doing first lien HELOCs as well, but they're doing it all on blockchain. They are doing it fast, quick, efficient. They've got a great securitization platform down. And so on the surface, it's like, okay, well, now this is expanding their first lien business. 𝐒𝐫𝐫 does a lot of the fix and flip product. They have a really cool AI valuation that is able to look at valuation post renovations. That's pretty cool. But there's 2 other things happening in the market right now that I think this spells good things for the greater securitization market. So this just kind of shows you where the PLS market has grown over the last few years, non-agency. And this is what I think is really cool about this. So the first thing is with Fannie and Freddie, we're seeing their credit box shrink, right? Second homes, non-owners, cash out refis, condos are about to become much smaller part of the GSE business, right? And Yep, ITINs, exactly, right. And so we're seeing that credit box shrink, and so you're going to start to see more people that need to go outside the non-agency market. And the other thing is the SEC is currently revising the Reg AB rules, and without being too technical, basically after the Great Financial Crisis, Reg AB required public disclosure of all of this loan level data to do mortgage-backed securities that basically killed that market, except for the private side, huge institutional investors. And so we lost a big part of our private label market because of these disclosure requirements. The SEC is currently revising those and looking to make it so we don't have to disclose all of this NPI for these borrowers on a public website. And if we can do that, we're going to bring back a ton more players into the non-agency securitization market. And so I think that market is prime to take off. And I think from there, you have even more innovation. Can they do different things with appraisals, different things with credit reports, different things with income and asset verifications? And so why I like this acquisition is Figure has built this platform on blockchain. It's very efficient. And so I think this could be the start of us seeing a resurgence in a much higher numbers than what you're seeing here of that non-agency market. So something to watch. I could be pie in the sky, but I think it's interesting and cool.
Coby, what are your thoughts on this?
Well, first of all, for $717 million, they could have signed Shohei Ohtani. So I have some questions about the acquisition. I have to admit, I'm, and I don't often admit this, but I'm it's a bit over my skis here with talking about blockchain and tokenization. It's not something I've tried to study up on it this week, getting ready for this conversation. What I did get out of it, and Erin, you seem to have a good grasp on this, is, we're heading towards an era where, and this may also work towards credit report portability for borrowers. We're heading towards an era where data is more nuanced, data is more secure, data is more controlled. Could we be getting towards this real personalization of lending products for consumers, because we know so much about the valuation, we know so much about the area, we know so much about the borrower, and we can actually put all of that data together and create specialized loan products that have just the risk. It just is minimized and minimized and minimized, because we know so much about what we're doing. And because they're not securitized in the normal way of just large pools that have similar features, we can actually do things that are much more innovative and much more creative. Yeah. I think that's kind of what I got out of this from my limited understanding. But Erin, you tell me if I'm on the right track with this.
No, that's exactly why I love it. I love the fact that that this is something, and it kind of goes back to the conversation we had on Bitcoin the other day of like, we need to bring more innovation to this market. The economy and the borrower profile today doesn't look like it used to, and our industry has got to adapt. And I think this is a good step to that.
Yeah. So a couple things that stand out to me here. Erin, do you have a hard stop at 2? Can your boss wait a few minutes if we run a little over?
He's pumping up my salespeople at our sales rally right now. So
you're
I'm
good
good.
Then. All right. We may hold you hostage a few extra minutes here, but look, if you look at how Figure made their splash in the second mortgage market, right?
Yep.
Erin. Yep. So, I think that there's two things here. What you said, really profound, that there's a lot of private money is very interested in the business, but I think it's more nuanced than that. We've used that word a lot, by the way. That is the leading word of the day, is nuanced.
I thought it was forward-looking.
And that is, there's I believe 28 trillion in untapped equity in this country. We've got, and to me, it's not as much indicative of money flowing back into mortgage as it is people seeing and feeling that rates are going to stay elevated for a long time and wanting to cash in on all this equity that's out there. You've got the HEI, which is the acronym for Home Equity Investments. This is something, this is a product where you share in the upside with the investor. Basically, as I understand it, you've got a certain amount of equity in your home. These people give you money. You never have to make a payment back until you sell the loan over 10 years or 30 years. And you then have to share in the appreciation of the property when you go to sell. That's an HEI loan. This is a market that's gone from, I believe, 3 billion last year, 6 billion this year. They think that it's going to be 20 billion in 3 years. So to me, if we're looking at a real signal here, it's that there's a rush. And I know this is not necessarily figure, right? Because they just acquired, they're going to start doing first mortgages. They're going the other direction, but there is a real conscientious effort and support for money in the second lien space and to find ways to tap into that equity that people can't get to. That's my takeaway on this. Let's go into the FHA fund, which is around 6 times the statutory requirement. It's just hovering under 12. And Coby, you've got a lot to say about this. I mean, FHA delinquencies, if we're to believe the headlines, they're surging. 92% is the number we're seeing. But you want to point out that this number is a foul. Tell us about it.
Yeah, there's been a lot of talk lately in the last few months about FHA delinquency surging. We've talked about it on our show. It's all over LinkedIn. It's all over, all the different articles that we read on a daily basis. And it's been used as an excuse for why we need to either tighten the credit box for FHA or why we can't reform either the upfront MIP or the monthly. And the reality is that the foreclosures are up. The foreclosures are up because of some of the backlog from the COVID era. And the delinquencies are up because of a change in the reporting from the trial payment plans. The trial payment plan change now says that you have to make 3 payments in a row before you're considered up to date. And that's a change from where it was. And so now there's a whole bunch of people that look like they're 90 days or 60 days delinquent or 30 days delinquent where they didn't, just before this change was made. Now, the other thing to note is that this is a permanent change to that reporting. So these numbers that are going to look like rolling delinquencies on FHA are all part of the reporting change. And I shouldn't say all. There is a slight uptick, but it's like 0.13 or 15% is the actual uptick in FHA delinquency. So the reality is that the FHA landscape is no worse than it was before we started wringing our hands over this in earlier this year, and we're in good shape. So it's time.
Well,
it's time to dump the 6 times that's there, and time to give it back to the consumers in the form of upfront MIP reform, and certainly at the very least, let the MIP burn off at 78%, just like it does with conventional lending. There's no reason not to implement that today, because by the time somebody gets to that point, they've already got, and this is from the CHLA from Scott Olson, they've already paid off enough to be 3 times what the actuarial risk is. So no reason for that not to happen today, but they won't, because it's part of the budget now, and they're reluctant, and that's why Turner won't say a word about it.
So we've gone from pearl clutching to hand wringing. So I'm just, as long as I'm like following along with Coby's sayings.
We're moving down the body.
Okay, so a couple of things on the TPP that I think we need to level set on. One is there is a 50% failure rate on those. And so that all of a sudden, once they clear that 3 payment threshold, they're not going to all automatically be current. 50% of those are failing. Second of all, the ones that do go through are 5 to 7 times more likely to go SDK again or SDQ again. Greg, if you have that graph I sent, I just want to show really quick. So this is plotting the SDQ numbers based on borrowers who have previously had a partial claim, the one on the FHA. Thank you. So this is showing borrowers who are SDK, so seriously delinquent, based on whether or not they've had a partial claim before. So they've gone through this TPP process successfully. 5 to 7 times more likely. The current serious delinquency rate on the borrowers who have gone through this process is at 24.1%. And so I think that, all of this whole conversation came up because somebody asked Cassidy if we should look at reducing the MIP. And he said, it's something we should look at, right? Not that we should do it, something we should look at. And so I'm not necessarily disagreeing with Coby on this, but I'm saying that it's too early for that. We just made a big change. We're seeing that a 50% failure rate on these TPPs. We're still within a year of that change. We're seeing really bad re-delinquencies, even on the ones who make it through. And so I think we need to wait a little bit longer to see how this policy change is going to work through before we start having this conversation.
What's the point, Erin? Then what's the point of having the fund then? What's the point of having the minimum? I mean, how do we ever get to a place where we're at 6 times the statutory requirement?
Listen, I don't disagree with that. And I'm not here saying we shouldn't do it. I'm saying that I think we need to wait until November with when the next change comes up, and let's see what this full cycle goes through with these changes to see what it looks like before we look at that number.
But we're always
right? That's all I'm saying.
Yeah. Erin, walk me through one thing though. I understand if you want to say, let's wait to reduce upfront MIP, because that is an important part of the fund. And if we eliminate that, the fund will be depleted pretty quickly because it is a big number. But tell me where the danger is today in eliminating the monthly MIP that got spiked up in, what was it, 2013, 2014 to be permanent for LTVs above 90%. Where is the danger today in letting that burn off at 78%? What do we need to wait for to make that happen?
So I don't disagree with you, but where the argument that you are going to get from HUD on that is that they don't charge a G fee. That is their G fee. And so when you do that, they lose that operating income that Fannie Freddie would charge or receive in a G fee. So I don't disagree. And I do think that we should look at that, but we need to make sure that HUD is able to operate.
That's very short-sighted. Very short-sighted.
You know how much HUD made last year? You know how much HUD made last year?
I don't know. I'm saying we should look at it. I'm telling you the argument HUD is going to give.
Well, but it's short. The argument is short-sighted because people are getting into FHA loans for the most part at 96.5 LTV. Right. It takes forever. It takes forever to even get down to 78. And believe you me, that MIP is stopping them from going back into the market or refinancing or doing anything they can to free up that money and get it back into the economy. Very short-sighted, in my opinion.
Yeah, no, I don't disagree. I think we should look at it.
16.1 billion.
Yeah, there you go.
Well, I mean, if you just look overall at Fannie, Freddie, and you look at
the numbers
HUD,
are about the same.
It's egregious.
Yeah.
Right. I mean, it's literally become a cash cow. I know a lot of the money on the Fannie Freddie side, I believe, gets poured into the Treasury. So it's like, how did we get here? Right. And I mean, this money is not supposed to be building up this war chest to be deployed to help to keep the deficit, down as much as it can. I mean, that's on the backs of homeowners. Like, we should be enraged at this.
By the way, we talk about me using pearl clutching, aphorisms, whatever. Do you ever notice how much Greg says cash cow?
I haven't. But you know what? I'm gonna pay attention to that. I'm gonna be the vehicle.
I have a proclivity for cows. I love milking them, apparently. So I've been told.
I think Nayang, can we do a cash cow mashup, like of all the episodes? Because
where is Nayang? Let's see if we can get Nayang. Is she even listening? Hold on. This is who makes it all happen behind the scenes. Whoa!
Oh, we got her.
There she is. Look, she just came down from the heavens. You see that light to the right on her face? She's an angel. That's it.
Get her.
She's one and done. She came.
She's going to kill us later. She's going to kill us later.
All right. We talked about Brian View earlier. I had him on my show one-on-one this past Monday. Brian is the president of MISMO, nonprofit arm of the MBA. And it's the Mortgage Industry Standards Organization. And I also had Dan Sugg on. And Dan is, I know, Erin, you're smiling. You love Dan. Everybody loves Dan. He's the chair of RESBOG. You're a member of RESBOG. We'll throw in that disclaimer. But we talked about this white paper and the new frame, which was introduced by MISMO. The acronym stands for the Framework for Responsible AI and Mortgage Ecosystem. This is really, 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 I can't say really enough, important that the industry stop what they're doing and listen to the threat, which is AI. We think about it a lot for how it's going to move the needle in a positive way. There are a lot of landmines out there that you've got to look out for, and the NBA has gone to great lengths to help make us aware of those. And this was my conversation with Brian, just a minute or so, and then we'll tackle it. Is there any one particular thing that lenders are doing that they need to stop doing right now around AI?
If you have not done a thorough inventory of your entire company in each use case where AI exists,
he said it all.
That's the biggest risk you have. When the state comes in or multiple states come in, should the CFPB kind of get some legs and they come in, or if you're a seller servicer and Fannie and Freddie start doing their MORA audits and you can't answer the question where you're using AI, you will have a problem.
I mean, this is, that's That's alarming, right? Because, you know, and I talked to James Brody about this, the high-powered mortgage attorney, a couple of weeks ago. This has been coming up, and Erin, you got a really close look at James Brody just in Ohio, didn't you?
I did. I had the pleasure of up close and personal on a panel with him.
He's
talking
such a great
about
guy. He's a great guy. But we're hearing more and more of this conversation, this dialogue around knowing what your vendors are doing, how they're interjecting AI. You know, everybody has said, including Brian on that call, that lenders are responsible for the technology that the third-party vendors are dropping into your ecosystem or using behind the scenes. To me, this is like a head-exploding thing to even begin to understand how to tackle it. But I'm so grateful that the NBA and MISMO are doing this. Erin, what do you want to say about this, and how many alarm bells should be going off?
I mean, if you're not looking at this, all the alarm bells should be going off. So I was fortunate enough to be part of the NBA's white paper process. It's free out there for anybody. Read it. It's got really great information. MISMO Frame, you get for free as a MISMO member. That is worth the price of admission, hands down, right there. The work that went into this is huge. And why I really love that is, you guys know I'm a big proponent for the small and mid-sized lender. And a lot of times those are the guys that don't really know where to start. And this helps you. This gets it there. And they're continuing to advocate with the agencies to make sure, hey, if we follow this framework, we're going to be in compliance with you, Fannie Freddie, right? Like, they're still doing like great work behind the scenes. And to Brian, his team, NBA, just great work. Please make sure you're going and looking at this.
Yeah. Brian, love the guy, you know, as you know, he gives shout outs to our show every week, and he's my partner on another podcast. And I know he's a big fan, and I'm a big fan of his, and I know we all are. Never has MISMO had as much momentum as they do now under Brian's leadership. So I just want to put that out there. But what I love is that we're talking about this as an industry before somebody regulates us or before somebody mandates it. And we're actually putting our own framework and our own guidelines together and having the conversations and discussing what's right and what do we need to be aware of. And the fact that we're doing that in the absence of a fully fanged CFPB, I think really speaks to our maturity as an industry, in that we're tackling issues before they're mandated upon us. So I love the fact that we're doing this. You know, the AI bot that called you, Greg, that you had the conversation a couple of shows ago that was so enraging. You know, that's going to be part of this conversation of what's right to do by the customer and what are we ultimately going to, get flack about from the federal government. So I love the fact that we're doing it. I love that MISMO and NBA are leading the charge. And I think we should be having more of these conversations around these kind of issues.
I feel like a yenta, like I'm always bitching. Is that me? Do you guys see me like that? I mean, do I need to sprinkle in a little honey?
I think you're the provocateur. I think that's your role.
Yeah,
I wouldn't say yenta. I would say provocateur.
Yeah, that's a terrible word, but thank you. I really don't appreciate that. Thank you, Coby. Hey,
you'd prefer yenta over provocateur?
Yeah, because only Jews understand yenta. I'm a Jew, so one out of every however many tens of thousands of people will understand that. So I can stay a little bit under the radar. But provocateur, everybody understands. Last thing here, Senate Majority Leader John Thune said Tuesday the chamber will move forward with its first procedural vote on the updated bipartisan housing affordability legislation. This is a long-awaited bill. It looks like there is a consensus now. There's a lot in it. It's 381 pages or so, and so this is coming down the pike. And how much reform it will lead to, I don't know, but certainly something that we're looking out for and that others should as well. Anything on those on the bill that you guys want to say, or we'll wait and see?
Go ahead, Coby.
Yeah, I haven't had a chance to really dive deep into it. I know we were circulating some emails about it prior to the show, but I didn't have a chance to really dive into it. The question I'm going to have is what actually has teeth and what's going to move the needle. I know that earlier iterations of it had some unintended consequences around investor restrictions on properties. I'm curious to know how those got fixed because I think those would have had some bad unintended consequences for the economy at large. So again, from the executive orders down to this, I want to know what actually has teeth, what actually is implementable today. What's going to solve some of the actual on the ground problems that we have. And so I'm just giving you that high level viewpoint of how I'm going to go into reading some of the details.
Yeah, I will say that I saw something that appeared to be on the surface a little bit alarming. I'll probably not completely nail this, but it was something along the lines of if someone has their DD 214, if they're VA eligible and you're presenting them an FHA loan, you must present them also a VA loan. So that's interesting to me. I'm not sure, I understand on the face what that's about,
Where did
but
that
to
come from?
to force a lender to present another option.
Yeah, that was one of the NBA's advocates. So NBA really was like, there's like, I think like 4 main points that the NBA really advocated for. The first was to eliminate that 7-year sale on build to rent. That's out of the new bill. There was also like a drafting error that would have made FHA multifamily loan limits actually go down. That's been fixed. So 2 big wins there. The 2 that are still in the bill, that VA disclosure, it's a little watered down. I'm still trying to understand the nuance, but it's still in there. And then there's also that is still in there. There's one more, the housing counseling. So anybody who's on a Govy loan that goes delinquent, so whether it's VA, USDA, or FHA, they have to be offered counseling, and that counseling has to be paid for out of the FHA MIP fund. So those 2 are still in there, but I still think I just have to say a yeoman's effort, honestly. Like NBA, Bob, Bill, Pete, that whole team did a great job on this. Chairman French Hill did a great job in making sure that the Senate didn't steamroll them with their job. So I just think all around another great victory for our lobbying teams.
Yep, agree with that. Coby, last word here.
Yeah, I mean, and now with Bed Bath & Beyond in the business, you can offer them an FHA loan, a VA loan, and a towel. So I'm super excited about where we're going.
Yeah, we're just not going to give them any of your towels, Coby. If you know
or
what I
any
mean.
or any of your socks.
Yes, there you go. How about that? Erin, we know you have a meeting to attend downstairs. You're in Houston with your whole amazing team from Interlink. You guys have a little rally going on?
We do. It's our sales rally, and I'm really excited. I love my originators. I love building my relationship with them. So this is a great time.
No, well, you're doing a great job all the way around for this industry, Erin and Coby, and this is a lot of fun. This is our 6th show in the books. We'll be back next Thursday. We'll definitely unpack the housing bill, Road to Home. It's Road to Home, right?
21st century road to housing.
Road to housing, yeah. So we'll definitely unpack that next Thursday. That'll be one of the things we talk about. Stop laughing at me, please. I've had, yeah.
I was laughing at Erin. In fairness, I was laughing at Erin laughing at you.
Now, how come you're not making fun on the record of her shirt? Before we came on, you had some things to say. It's a lot different than when I wore my shirt, my late shirt, I should say, where you just buried me publicly. What do you have to say about this shirt, Coby?
Well, when she first wore it, I thought she was, wearing a sponsorship logo, like she was starting to make some money on the side. And I thought it was the Motorola logo, but it turns out somehow that's the Interlink logo.
Interlink, my number 1 sponsor, baby.
But how do you spell Interlink out of that?
I and then the M. Put it together. Listen, I'm not a marketer.
Yeah, Coby, don't quit your day job, buddy. You're never going to be leading a marketing team, clearly.
Yeah, you are not the vehicle for that.
And that's the hill I'll die on.
It is, and you're not even bloviating. This has been a great show number 6. We'll hit 7 next Thursday at 1 p.m. Eastern. Until then, so long, folks. Bye-bye.
No surrender on the show. We go toe to toe. What's fair? What fair?